The Share Pickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Live! The Weekend Podcast with Steve, Pete and Paddy.
And Paddy.
Say hello, Paddy. Hello, Lolly. That's my dog, Lola. She's 2 years old, and she stood in for Paddy. To be honest, she's given me a lot more content than Paddy has over the last few weeks.
That's true.
Yeah, he's got a reasonable excuse, though. Lads, in fact, before we came live, we were actually staring at Lola doing some business in the garden, you know what I'm saying? Some real business. We're staring at her. Go on.
And joking that she was going to run and jump straight and put them on Pete.
And she ran and jumped straight on Pete's lap. Welcome, guys. Welcome, by the way, ladies and gentlemen. By all means, use the chat function in the side there, and Pete's on that. Anything you want to ask? Have you had any questions so far, Peter?
No, just a couple of people saying hello.
Hello.
Hi.
See, it's live. We can interact with that kind of stuff.
Yeah.
Look at Lola trying to get comfortable. Hello. Anyway, do you know what? I'm going to give you a little, straight off the bat here, I'll give you a little tip, all right? A little secret. Do you know how to make money? And people release videos on this alone. Do you know how to... Oh, see, Lo, she's bored. She doesn't want to make money in the stock market.
First viewer off.
Do you know how to make money in the stock market, right? How to make money. It's simple as this. Do not sell at the bottom. Oh, we're back to Lola now, doing a business. Do not sell at the bottom. Simple as that. We are in a bear market. Now, keep realising this, right? We are in a bear market. Simple as that, right? Don't sell at the bottom. Worst place to sell, ever. It gets very emotional at the bottom, but don't sell. It's the worst place to sell. Steve, Pete, have you sold anything at the bottom?
No. It does get very emotional at the bottom. You're right.
It does get for some people more than others. Anyway, and it's a running theme here, right? It is tough at the moment, but if you listen to this or know someone who's thinking about investing, one of the best times to invest is right now because we are near or close to the bottom. And if it goes down even further, right, that's again another bottom. Don't sell at the bottom. That's the way to lose money. The old adage, buy low, sell high, it's very hard to do. It just gets really emotional, as we know.
And I think another thing to be caught out, and not just selling at the bottom, I think selling at the bottom when it just had a little peak and you think, right, that's it, and then selling out at the bottom, but not quite the bottom. So kind of like
you should release a video of that, Steve.
Semi-bottom.
How to sell not at the bottom, but quite near the bottom.
Like belly button area.
That's break-even Stephen talking there.
Break-even Stephen. Yeah, but you know what?
It's tempting though, isn't it? You should have a little rise out at the bottom. You go, right, I'm out now. And
break-even Stephen. Don't go for that.
Yeah, no.
You want profit Stephen. It's some kind of catchy name, that. Anyway, listen, Steve, maximise the screen there, right? Here we go. Ladies and gentlemen, join in if you want. Who is this man?
Oh, hang on. Sorry, we had a bit of an error starting this.
Oh, Stephen.
Steve, technical error.
No, that's not it.
Oh, my word.
There we go.
There we go. Who is this man? Okay, not Steve. If you know...
It's Jerry Springer, isn't it?
Don't say... Does anyone know who this man is? If you know who that man is, type it into the chat box.
Okay, yeah.
Into the box of chat. You know what I'm saying? Type it in there if you can. So, who is that man? So, you haven't got long. Even initials is good.
What's the prize?
The prize is a date with Steve.
Cool.
Yep.
Yeah. Or a date with Paddy.
Yeah.
But, go on.
Second prize is two dates.
Yeah. Do you know who that man is?
I think I do, yes.
Okay. Steve, do you know who that man is?
Yeah, no.
Okay. He is Peter Lynch. Okay, have you ever heard of Peter Lynch, Steve?
Yes. No, Steve.
I've heard the name Peter before. Peter rings a bell.
Isn't he in Boyzone?
Yeah, that was years ago.
Yeah.
But Peter Lynch, an American investor, mutual fund manager, and philanthropist. Do you know what that means, Steve? Mm-hmm. He likes a bit of philanthropy. Hooray! I fancy a bit of philanthropy. Round the back of the pub.
Shout out to James Cross, Martin Morgan, and Jay. They've all got it right, so well done.
Well done, guys. Who was that? Give him a name check.
I just did.
Do it again. Make it seem like more people are watching.
Yeah, okay. Oh, and also James Cross, Martin Morgan, and Jay as well. So well done.
So, as the manager of the Magellan Fund, which is part of the Fidelity Investments, between 1977 and 1990, Lynch averaged 29.2% annual return, consistently doubling the S&P 500. The benchmark is the S&P 500, doubling that, making it the best performing mutual fund in the world, ladies and gentlemen, right? So, in that 13 years, he turned 18 million into 14 billion. Look at that.
Wow.
18 million to 14 billion. That's impressive, isn't it?
Yeah, quite.
This is what he said about bear markets, right? Now remember, we're in a bear market. Do not sell at the bottom.
Oh, right, okay.
We're in a bear market, right? Just hold on tight. It's fine. It's like, just
We just put that on the wall behind us.
Yeah.
And then save you.
We're in a bear market.
saying it all
Do
the
not
time.
sell.
Yeah.
Okay?
Right.
He said a bear market is a 25, 20, 30% decline. They're going to happen. They're going to happen, guys. He's American, by the way.
Oh, I didn't get that.
Yeah. And he said, when they're going to start, no one knows. If you're not ready for that, you shouldn't be in the stock market. Now, a lot of people are selling right now. It's the worst time to sell. You are making the worst decision ever. Even if you're a crap stock, the market will rally, it'll lift up with the rest. The tide lifts all boats, you know? At the moment, the tide's gone out. Do you panic sell your boat because the tide's gone out? You don't do that, do you?
No.
I don't actually have a boat, but I mean, if you did have a boat,
Right, okay.
even if it's a dinghy, you would say, tide's gone out, pointless. What's the point of having a boat? You sell a boat. And the guy goes, well, I can't even sail it. There's no water there. I'll give you half the price. Oh, go on then. And then the tide comes back in, and he sells it for double the price.
Yeah.
Anyway.
Steve's done that.
Yeah, he done a lot. So he said, the stomach is the key organ here, not the brain. Do you have the stomach for these kind of declines? That's what he said. This is a guy who's one of the best in the world, you know? And he said, what's your timing like? Is your horizon 1 year? Is your horizon 10 or 20 years?
Okay.
That's actually how he talks.
Is it?
Yeah.
When he said Boyzone, he was quite Irish.
Yeah. If you decide to invest in stocks directly or through a mutual fund with a 1 year horizon or 2 year horizon, that's silly. That's what he said. Are you warm, Steve? He's the colour of his jumper.
Luckily, I've got control of the screen, so we're not on screen at the moment.
Okay, sorry.
Am I a bit red, am I?
Yeah.
Lost almost.
Well, that's cheap. Put the heating on just before we started. It was boiling
So
you.
it said basically that's just like betting in red and black in the casino. Okay, the horizon is a very important thing. Don't think if you're you can trade. But he said what the market's going to do in 1 or 2 years, you don't know. Time is on your side in the market. Right now, we're in a bear market. Do not sell at the bottom. Okay? Simple as that. When stocks go down, if you've got money, don't worry, put more in. You shouldn't worry about it. That's what he said. Hang on, go on.
All right.
Yeah, but I think this is the last thing he says. You should worry where the stocks are going to be in 10 or 20 years from now, 30 years from now. He said, I'm very confident where they'll be. So essentially, if you don't need your money now, unless you're very desperate, why would you pull your money out at the worst possible time? Why would you do that? Well, unless you're desperate.
Yeah.
Or stupid. Or you're worried about the market. Or you just get emotional. You haven't got the stomach for it, you know? So that's it.
Yeah.
Can you handle it, Peter?
Absolutely.
Yeah.
Can you?
Absolutely.
Good. So a point's come in from Hamayi12. That's their name. But do we know if this is the bottom? Russian-Ukraine risk hasn't disappeared yet.
Yeah, don't worry about that. Don't worry about that.
It's a fair point.
Yeah,
You don't know for definite that is
No,
the
we don't
bottom.
know it's a bottom. Regardless of that's a bear market. Like I said, it could do down another 20, 30%. Doesn't matter. Unless you need your money now, it doesn't matter. It will rebound. We've had world wars. We're not in a world war now. We're on the edge of one, maybe. But we're not in a world war now. You know, we've had a great financial crash. We've had huge crashes. It's happened. The stock market's always recovered. If you, like Peter Lynch said there, if your horizon is of years, 5, 10, 20 years, don't worry. It'll recover. It's worth looking, and this is what he said basically, is rules, stock and bear market correction investing. He said, How to invest during correction. Focus on a company's fundamentals, not the macro. You can't do anything about the macro. You can look at it through the company, that's all. Winning's almost certain in the long term when the strategy is correct. So if you're investing in decent stocks, you're looking at maybe growth, valuation, cash levels, all that, you're okay. Stop worrying about market correction and its longevity, how long it'll last, all that stuff. By the way, bear markets generally last around 12 to 18 months. There's been some longer, but some shorter. Of course, the average is around 18 months. And microcaps, we've been in a bear market now for like a year. So we may bounce around the bottom for a while, but again, it doesn't mean all stocks will go down. Anyway, let's just bring that down, Steve. Put our pretty faces on the screen, fella. There we are. Steve's getting redder and redder as we go along. It's nice. Are you matching your top, Steve?
Hang on, I'm going to sneeze.
Oh, we'll wait for that then.
We haven't waited.
No, I'm good.
So anyway, when Peter Lynch talks about... Stop looking at this, my notes here, Peter.
Why not?
It's like when you see Peter on TV, standing next to someone reading an auto cue, and the guy next to him goes, You shouldn't be miming it. When he talks about stomach there, he's obviously talking about emotion. And the difference is essentially, with making money and losing money is all about that, you know? Two people can buy the same stock, exactly the same stock, at the same price. One can lose, one can win and make money. The one that loses generally is basing all his decisions on emotion. It's all about emotion. It's all about it. It's not easy, but if you can handle it... Steve, let's put the screen up to max. Okay, if you sell just because the share price has gone down and you are underwater, you will only ever lose money. That's all you ever do. Let's go, share price gone down. I'm underwater, I'm going to sell. You can't make money doing that. That's impossible, isn't it? It's literally technically impossible to make money if your share price goes down, you're underwater and you sell. If you do that every time that happens, you're only going to lose money. But people do that. I came up with this earlier with the help of Peter a little bit. So you've got a general market sell-off, right? What do you do? If it's a general market, if the share price has gone down, it's nothing to do, it's not company specific, you know? You sell, take a loss. That's it. Once you sell, you've taken a loss. You've lost money. Hold, wait for recovery, maybe sell later at a profit when the entire market's gone up, okay? So share price drops. Has the original thesis changed for the company you invest in? No, hold. If it has, sell. And you have to take a loss. If you think that the company's changed now, it's no longer the company you invested in, or the main tenet of that investment is there. There's no point. All right, Steve, you can put it back to minimum now. There we are. Thanks. So there we are. Does that work? There we are. Lovely. So if there's one, we haven't finished here. I've got 100 slides left, but it gets better. So the one, and you know what, it's hard because I've been doing this for a long time. And it's very easy to obsess over share prices and portfolio values and all that stuff. But if there's one message I want to say, right, in part today, is if you're a long-term investor, not a dirty trader. Okay, if you're a dirty trader, get out. Okay, but focus on the business, you know, and its operations. You are a business owner, and you got to think of it like this: like you own the business and the entire business. That means ignoring the share price. I speak to lots of CEOs actually who say, you know, the business is fine. I can't do anything about the share price. It's annoying, but I can't do it. All I can do is focus on the things I can do, you know, and that's the operations. So ignore the share price. It's a very hard thing to do. Just ignore the share price and literally focus on the business. That's what you can do. And do you know what? Businesses never run smoothly, do they? Steve goes on business. He does this kind of stuff. Some months they're very, very busy. Other months they're not. And sometimes you go out and, you know, with a client, and something go wrong with it. Some things that happen. Equipment will break. You know, businesses do not run smoothly. That's the thing, you know.
Sometimes you start the intro to the show twice.
Sometimes you do that, Steve. Yeah. It's a good job you didn't do this time, isn't it?
Yeah.
You know, so like I said, but the thing is, if you look at a long-term view, is the product in demand? In fact, a couple of examples here, right? So, Biome Technologies, I get into a bit. They had guidance cut for their 2021. Why? Because there's supply chain issues. That's not their fault. You know, that's a global issue. They have demand for their product and they were expecting to do 40% year-on-year growth, but the demand is still there. They've said that. No customers have shown a lack of interest or less interest in their product, but They can't. It was taking them like 2-3 weeks to ship to America before the supply chain issues. Now they said 5 months to get something to America. It's better now. But
and I guess the customers can't go elsewhere because it's going to be the same with any other business, isn't it?
Well, with Bio, it's a 4-stage thing. They have a meeting with them, set test pilots. They produce some stuff for them. They do test runs. And all that. So it's a long. And once these customers are on board, they can't get off because they spent ages with adapting their products for these manufacturers, for these people, these coffee pod people, all this. They can't just sort of say, "Oh, we'll go somewhere else," because they can't spend a year or so, a couple of years, 2-3 years, adjusting and working with Biome to get the product right. So ignore the share price. By the way, we are in a bear market at the moment.
Oh, okay.
Yeah. Do you know, and I think it's the only reason why you should actually look at a share price is if you're looking at a company's valuation, trying to work at the valuation, trying to work at the value of the company and what value it can create. Ignore the share price. Focus on the business. There's two different things there. And the share price doesn't reflect the business often, And in fact, it very rarely does. You can see share prices rocketing and the business is doing okay, or it's not doing okay, or you'll find out when the results come. Or you can see a share price dive for the rest of the market when the business is doing fine. So just look at the business. If the business is continuing to improve, that's it. All you need to know. Do you know what I was thinking the other day? Right, I was thinking sooner or later, this bear market will end with a massive rally. Putin will be shot in the head. We'll all have parties,
right?
And regardless of what business you're in, the entire market will rally. And you can see right then, do you know what? I held through a pandemic. I held through global supply chain issues. I've held through a big European war that threatened to become a world war. I held through a period of inflation that we hadn't experienced in the 1950s. And you know what? I didn't pay any attention to the macro noise. I just focused on the business I own as a business owner, and it all turned out fine.
Can I ask a question?
Yes.
Knowing what you know now and how those events that have happened, would you have played it any differently longer term in terms of always had a cash reserve that could take advantage of these dips like this now? Because I don't. This is the problem for me. I don't.
No, I know, but that's like saying, wouldn't it be nice to know, knowing the lottery numbers we know now?
Well, it is.
It's like, wasn't it nice to know pick those numbers?
No, it's fairly cyclical, isn't it? Because it does happen fairly regularly. And we've had a bit of a crazy, unprecedented sort of 3 years now, but it kind of makes you think, no matter how tempting it is to go all in, you should always keep a reserve because there are these kind of events.
Yeah, but we've been there before, and we've all gone into cash. Cash at some time. But the problem is you sit there with cash, and all I think is, I'm wasting my money just sitting there in cash because I want to put it somewhere to make money.
But then now you'd be sitting
there. Yeah, of course.
But even with cash, you're losing 10% now with inflation. No, but
so answer my question.
My answer is this: I often talk about how to get into companies and when is the good valuation, when is the right price to get in. I never talk about getting out. I will be looking at that very soon, and that's to do with cyclicality and to do with value. Basically, I mean, it's trying to get a certain entry level of a company at a certain value, and then when you realize it's maybe a little bit overvalued here, you're in profit, of course, then you top slice, because you can have a business cycle where the share prices race ahead. It'll happen soon, But I was thinking today, I was in the shower. In fact, I was listening to, who was I listening to? Steve Bartlett, his podcast.
I think I see you listening to me in the shower.
Yeah. And I listened to the guy from Gymshark, amazing guy. He's only 20, and Gymshark has turned over hundreds of millions. Worth listening to that podcast. The guy for the new. What's wrong, Steve? You all right?
Got a spider in my drink.
No, that's good. That's a money spider. He's drowned. He's underwater. Tell him it's a bear market.
Yeah, he's at the bottom.
Yeah, he's at the bottom. But I was thinking, right? The stock market is a wonderful thing. It is a wonderful thing, and it gives people a chance to own a part of a truly wonderful growing business. You can find those businesses that are doing really well. I mean, even in the American markets, there are people who invest in Apple and Amazon when they're literally close to, well, not penny stocks, but close to, and they've done thousands % But all you do is hold. But they went through masses of volatility. Amazon dropped like 90%. Facebook dropped by 40% in 2 months in 2012. What else? Apple's done like 60% drops. And so those businesses have volatility. But you literally don't have to get bogged down in the drudgery of being a business owner, of doing admin and dealing with management, managing people. You can sit there, invest in businesses. That's all you have to do, is just keep up with the updates, read the updates, follow the business, all the interesting bits, rather than have to deal with admin, tax, all that nonsense. So it's one that you share in the wealth of business and make money for years. Yep. Okay, Steve, maximum screen, put us in the corner there. You like this, I think you like it. Not a lot.
No.
One of the things these days about coming up with little sayings from people who are famous from the past is you've never known if they've been arrested for dodgy things now, do you?
That's true.
You say something, and say, oh, that's a Gary Glitter. You shouldn't say that. Oh, sorry, yeah. So what is this, right?
It's a gearbox graphic.
Steve, any guesses?
Well, yeah.
Any guesses on Twitter? Any guesses on Twitter? In fact, can we put YouTube live on Twitter these days? Can we do that?
Can we put... What?
YouTube can go live on Twitter, can't it?
I don't know, can it?
I don't know. I see Sky and
Twitter for about 10 years.
You can link from it.
Anyway, see that there? What is that there?
Yeah, he said it's a gearbox.
Well, it's not a gearbox.
It's not a gearbox, is it?
It's not a gearbox.
Yeah. Well, what's this now, right? What it is now? This is the car gear analogy for microcaps. Okay?
I'm looking forward to this.
I bet you will. Watch this now, ready? So, loss-making, right? Pre-revenue company. Essentially, why I say they're in reverse a little bit is even their operations, they're reducing their assets are depreciating a certain extent, cash assets, liquid assets, because they're having to spend everything and put it into the business. They're not generating anything yet, you know. So then, get into first, right? You go. That's revenue growth. Most of the companies I'm investing now just have revenue growth. That's all they've got, right? What do you think the next gear is? Change up. Where's the next one? Change gear. I've often been in cars with people who go too much on the gears, you know. You need to change up a bit, you know. They really strain the gears. Ease it up a bit. Change gear. Change up. What's the next one, do you think? Steve just looking at me like... Steve looks at me like... Lola looks at me like a food.
I'll just sit here and wait.
Just stare at the food.
I'll wait for this bit to pass. Revenue growth. Look, the next stage.
Change gear. EBITDA positive.
Okay.
Yes, it's exciting, isn't it?
Okay.
Change up. Operating profit, see? That's after operating...
Bankruptcy.
Profit before tax. Now you're going in fourth gear now. You're starting to move. You're making... You're gaining some ground here, you know? And they've got dividends.
Yeah. It's quite an old car because it's only got 5 gears.
How many gears do you need?
I need 6.
I haven't got 6.
I got 6, yeah. I've got 7 in mine.
Yeah. That's a waste. How often do you use that?
I don't know. It's automatic.
Yeah, see? The car does it with me. And also, not only that, I've added this, right? So look at this.
Right.
Time horizons, like Peter Lynch talked about, right?
That's a long time to get
revenue growth. Yeah, revenue growth. After year 1, should we get revenue growth? That's what I'm saying. Year 1, 4 year, right? Year 2, EBITDA positive. Year 3, operating profit. Year 4, profit before tax. Year 5, dividends. That's a holding period, really. Where we are right now. I mean, I've held Escape now for like what 2 years. Mm-hmm. So they are EBITDA positive, pretty much. They'll be going to operating profit for soon, and then a couple of years down the line, they'll be doing that. You know, all the things we can be paying you income as well as capital upside. See, nice. Okay.
Did you come up with that all by yourself?
Yeah.
Well done.
Yes, all right.
Well done.
What's this then? I like this one.
Glass of fizzy, like an Alka-Seltzer.
Alka-Seltzer. I thought it was going to make my armrest.
Lemonade.
I thought it was a slick thief.
Water.
A slick thief who came and nicked my armrest. Did you see him?
Oh yeah, a lot of people nick armrests.
You never know these days.
No, exactly.
The cost of living's gone up. You know, you sell that.
See an armrest, nick it.
Yeah. Any guesses on the YouTube, on the Twitter, on the socials? Is anyone there at all?
There's a few questions. We'll go through them in a bit, but
we'll get through the questions now. Let's have a little guess for any questions.
A couple of people asking about Gfinity. What's Pete's view on Gfinity?
What is your view on
What's my view on Gfinity? Well, disappointing as everyone was the other week with the placing, the way that was handled. I think that's tough, but I'm still holding. I haven't sold, and I think the longer term outlook is still pretty positive. It's frustrating, but hang in there. What's Pete and Steve's view on Biome? Well, we'll get to Biome. Are you going to talk about Biome?
Yeah. I'm going to go through all the companies now.
And then another one talking about Gfinity. Are you still in, Justin? Gfinity?
Yes.
Absolutely.
Yes. Yeah. Of course, I didn't tell you. I didn't know if I told you. But I took part in the placing. I didn't have much from the placing. In fact, I had a troll saying that, just not no cash, they win a placing. Oh, from a broker, he's never contacts. Finally, the broker contact. There's a broker, right, I'm friendly with, that I've known him for like 5-6 years. In fact, I think the first time I took part in the placing was with this broker in Asia Met years ago, and I haven't done any placings. I haven't taken part in any placings for like since then. Asia Met, I think, was the last thing. And when we talked about Asia Met, that was like, 5-6 years ago, was it? Yeah. So I'm not going to mention the broker, but he's subscribed to the blog. He's subscribed to my YouTube channel. We're friends on Twitter. We often text. He knows what companies I'm in. He doesn't approach me with placings about anything like mining companies because he knows I'm not into that. Gfinity happened. He said, I know it's gutting. He said, but there's a placing going on. Do you want to take part? I said, let's try and rifle some money up. I was trying to ask the missus for money. She didn't want to have it. No, you don't have my money. So I get some money. So, but with placings, what happens is you always get scaled back because there's always I know they always say they're always oversubscribed. A lot of them are though, because especially they've done it at a massive discount like that, and it was oversubscribed. So I applied for a certain amount. I got scaled back to 40% of what I actually wanted. But yeah, so I'm in the place. No, because this is it. My view on Trufin is this: the esports business, the yearly contract things with Formula One, get rid of it, sell it, get rid of it. It's no good. It's low margin. Now, and you may take a little temporary knock on the revenue, but the goal here is the digital media business and the tech IP, that they can sell as software as a service on recurring revenues. That's the goal. So, and that will be profitable. It'll be profitable on GDM pretty much by 2023. So, the top line won't go down, but the margins will go up and the earnings will go up. So, yeah.
So, a question
that's scalable.
A question connected to that. Can Gfinity's GDM grow organically without further acquisition? First question.
Well, that's the thing. I was thinking about that. Well, I mean, if you look at the average user, price per user, that's gone from 4 pence when they originally started, now 23 pence within 2 years, and now up to 16 million. A record month in February, which is a short month, of 16 million users. They want to get up to 100 million. I don't know. They may need some more acquisitions, but they still haven't sort of. I don't think they've utilised the entire power of their sites yet. So who knows? But they're not, I mean, you've got to hold. John's a lovely guy, but listen, he's set 3 of the companies I own 6 companies. 3 of the companies I own now have stated publicly they're going to be profitable by a certain period. Okay, that's XPF, Gfinity. In fact, XPF are generating cash, so that's the most. Gfin said they'll do it in 2023. They've got the cash. They got 5 million pretty much. In fact, more than that, because they got 2.5 million from placing, 2.5 million from warrants, and they had about 800,000 in cash anyway. So they'll get to profitability on that. If they don't, or it looks like they're not going to get there, I'm out, pretty much. And Trufin announced recently they raised the money. They got 4 parts of the business, of course. Oxygen, Virtus are profitable, and this cash will get PlayStack and Satago. Oh, Satago. They'll get that to profitability. Right. Satago is going to be a monster. By the way, I chatted with James on Friday. We recorded a podcast. I had to send it off to his brokers to get past it. They haven't come back. But he was very guarded in the interview because Lloyd's and everyone listened to it. He said, I can't say what I want to say, what I like to say, but I know he believes it's going to be huge, Stargo.
Lloyd's listen to this podcast?
Lloyd's, not this one.
Right, okay.
Anything to do with Trufin now because they're a partner. They're invested in Stargo, Lloyd's. They've made an investment. Doesn't happen very often. I don't think people understand that. Lloyd's is the biggest retail bank in the UK. If you set up a business, right, it's taken years to set up this business. Of course, one of the members' brothers set it up, but couldn't afford to start because you have to plough a lot of money into developing it and all that stuff. Trufin would be listed, could do that, and so he just sold it to them, to Trufin. But they're at the stage now where the first software as a service commercial deal they've done is with the biggest retail bank in the UK. That is like. It's like you wanted to play golf, right? And you say, I want a little professional to help me. I'll go to the little club and hire the professional to just help me, mentor me and thing. You turn out there that Tiger Woods has taken a year off golf and he's gone to the little club. He said, I'll help you out. It doesn't get better. You will not sign a better deal in your first commercial deal than Lloyd's Bank. It's one of the biggest, it is the biggest retail bank in the UK. It's got 30 million customers. It's big on the SME front. It's a golden deal. And that now, they said, the reason why Lloyd has gone with them, it's best in class. There's no better. 11 companies went in for that deal. Satago got it. Best in class by a long way. This is not the last you'll hear of Satago's with big companies. I genuinely think, and James, he thinks it's going to be a unicorn, and that means a £1 billion valuation on Satago alone. And it's the most scalable business I own. And it's one of those things that could be a UK tech unicorn. You say, wow, that's an amazing company.
Why is it called a unicorn?
Because those horns, they cost about they cost $1 billion.
Right.
Buy a horn costs $1 billion.
Yeah, they're so rare.
Can I skip back to Gfinity because the other part of the question?
Oh yeah.
Their tech IP might become a real earner, but why would a AAA game publisher choose that tech over their proprietary platform?
Again, because they've used it. Some of the big companies have used this, like esports, Formula One, all that, and it's best in class. I mean, there's a Hugo Drayton who's from Digital Media. He's Future PLC, and a couple of others said it's the best in class. And in fact, they trialed it with a big companies apparently, and they said, you are majorly underselling this. We've tried other software. It's nowhere near as good as yours. So it is best in class. But again, software, when they start up and start to launch it commercially, it takes a bit of money. So now they've got some money, they can do that. So, but yeah, they're saying it is a bit of that can be a game changer, the thing. But I mean,
in any business, you're always going to have competition, aren't you? So you always, but that's part of being in a healthy kind of market and healthy healthy business. So okay. Time will tell whether that's the case. Okay. Pete and Steve are older than I imagined. That's another comment.
Yeah, I saw that. That's a bit rude, isn't it?
Hang on. How much do they make? Maybe you sound young of voice, young of heart.
Yeah, maybe.
Maybe you're young souls, guys.
Yeah,
we're actually going grey.
Steve's 68. He's looking all right.
I'm all right for 68. Yeah.
Yeah. I always used to get that. We all used to work at Red Dragon FM. South Wales. Remember they used to get a Welsh voiceover? They tried that for 1 year, didn't they? Yeah. And they've gone back to American. It's funny how American voices worked on the radio well, or just cool voices.
Well, we did have Steve Jones, the FM.
Oh, yeah, he did. There was a guy who did it for a while. It didn't sound Red Dragon FM. It didn't sound like... Anyway, we all worked there. Where's I going with that now? What are you saying? Oh, yeah, no.
Age.
Well, I used to work at...
Getting stuff.
Yeah, my voice sounds old.
Yeah, I always thought you were an old man.
I didn't realise that, because... Even when this is odd. Even when I had hair, I do still have hair. I used to get back to taxis, and people would say to me in Cardiff, because it's quite a well-listened to station, wasn't it, in the day? And people would say, "Are you Di?" Because I used to be called Di on the thing. "Are you Di?" I said, "Yeah." "God, I imagine you'd be fat, 50 and bald." I'm there now. And my voice, I've caught up with my voice. Literally, that was when I was like 28, 27, 28. But I'm actually there now. It's funny, Monty said to me yesterday, "Shut up, you bald idiot." So that's Monty, my son, right? So I said, "What, I choose to be bald, and I'm an idiot, but I'm bald because I'm an idiot? Or which part of I'm an idiot and I'm bald, or because I'm you bald idiot?" That makes me laugh. Anyway,
there's been a few guesses around soda water, tonic water. I mean, everyone's on the edge of their seats.
I had these two ideas: the gear stick idea and this while I was in the shower. Watch this now, right? Here we go. Watch this now. Watch this now. Watch this now. What type of company is this?
It's utilities.
Yes.
Hydrogen.
What do you see? Say what you see. Say what you see. Hey, say what you see.
Tap manufacturer.
No, it's not a tap manufacturer. So what kind of water is coming out of the tap? Is
blue.
But is it consistent or is it
drippy?
It's drip. It's not very consistent, is it? You know, what can you see on the side of the glass there?
Tadpoles.
No, are they buttons or they? What do you think they are?
Bubbles.
They're holes.
Oh, I see. The black things are holes.
Yes, they are holes.
Well, how is that water not draining out of
Well, hang on. I was going to ask you to do this bit because you're better on the artwork than me.
Oh, okay.
I thought, no, I wouldn't do it. So here we go. Look at this. This is a pre-revenue loss-making company. Okay.
What, that drip?
Yes, placing inconsistent funding. See, the funding comes in every year, every half year, whatever. However often they place, it's in fact it's loss-making even, not even pre-revenue. Because if you're loss-making, where does the money come from? If you're not generating organic, cash flow, then it's got to come from somewhere. It's only going to come from, equity or convertible loans or debt. Most companies can't get debt, bank debt, because they're not generating, profits. So.
You don't get this on Bloomberg, do you?
Look at this. Pre-revenue loss. The second placing. Have you noticed the size of that? Look at that. It's gone bigger. Because the dilution, the market cap has gone up. Now, the company becomes bigger because there's more shares in issue.
Yep.
See? And existing people in there are diluted. Now.
Yep.
That's the cost of sales.
What, that hole?
Yeah.
Right.
So obviously, that water gets filled up. That's revenue.
Yep.
See, it's cash.
Yeah, drains out.
It drains out. Cost of sales there. Admin expenses as well. All right. Now, what company is this? Have you noticed the difference in the tap there? The water.
Yeah, it's gushing.
It's gushing. Yes.
Right. High growth.
Well, it's a revenue generating company. See, it's generating revenue. It's not pre-revenue. The last one was relying on seed placings, drip every now and again. This now has consistent flow of money coming in. See, but it still has
holes.
Cost of sales. Of course, they will. You'll still have cost of. But you need to get above that first hole. Is when you get gross profit. See?
But it would still keep draining out.
Not if you got maybe the scale of the holes aren't right, but if you got more volume coming in, then the hole is.
You'll never get past that hole.
Well, you will. Because
the rate of revenue is
rate of revenue is so powerful. Yes, maybe the holes need to be smaller. Maybe that's it. But what I'm saying is, you need a certain amount. So, but you're only getting gross profit there. Yeah. That's all you're getting.
All right.
That's look at this. That's admin expenses. If your revenue is so good, it's growing so quickly, you get above that. That's operating profit. Then, right? So that's your operations are actually creating money there, and then profit after tax. You get a tax there. The third hole is tax. You see that? You see how it's working here?
Yeah.
And then look. And then dividends, way! That actually overflowing. That's what it is. So dividends are paid out of profits, you see, after-tax profits, So you can't pay dividends.
Yeah.
You shouldn't be doing that anyway. If you're a loss maker, you shouldn't be paying dividends. So that's where the dividends come from, of course. You pay it from the profits, So that's
okay.
Do you like that? That's pretty much how a profit and loss sheet, income statement works. You got gross profit, you got revenue, gross profit, cost of sales, cost of sales, gross profit, and admin expenses, operating profit, pre-tax, post-tax, all that.
Right. Okay.
That's turn it round, and that is an income statement. You see?
They should just release a picture like that.
Yeah. But do you see what I'm saying? That the revenue, you get a certain amount of, you've got to get to a certain gearing level of revenue before you can cover those costs. Yeah. Before you can get to cover those holes. Maybe the holes will be smaller. Maybe I've misrepresented the holes, but that's how it works. Does that pictorially help you, Steve, in some way?
Not really.
I'm glad I spent the time doing that then.
Yeah, right. Right, we got another one.
yeah.
How about this?
Right, what I want to do, right? Let's look the source of your worry, right, during a bear market. What are your worries?
Are we in a bear market now?
Oh, yeah, we're in a bear market now. Okay. Do not sell at the bottom, ladies and gentlemen. Just hold on tight. It's like a scary ride at the fun fair. You want to get off. It'll get better after a while, It's like one of those, one of the worst ghost trains in Porthcawl about 3 weeks back.
I beg to differ. Barry Island's worse.
No, do you remember we did that?
You had to walk out.
Yeah, we went when we were at Red Dragon. Did you go to that? Do you remember that? No. Well, maybe you'd left by then. But we had a day away. Dave was there, organised a day with his friends. They shut the park. I think they shut the park, or no one was going to the park. But we had the park to ourselves, and we all of us went on the ghost train. Everyone from Red Dragon on the ghost train. And so nothing was much happening on there. And all of a sudden it went stopped. It was quite dark, and it just stopped. Silence, right? We just all sitting there. What's happening? What's going on? What's going on? It wasn't. Right, you have to get off. It's broken. Follow me. Should go up water. That was the best part of the ride. That unknown uncertainty. That's his good analogy. The uncertainty.
Oh, that's better.
Of what was going to happen there in that ride.
Going into the ghost train.
So that's the uncertainty of the market, So right. So let's look at your fears. What's the biggest fear you have? The worry about the markets. When you look at the share prices, your portfolio. What do you worry about? What's the worry? What do you? What is
currently?
Keep me up.
Well, it's just the potential for World War III, isn't it?
Yes,
that's the biggest, and the cost of living crisis, and that's tied in with energy and the war. It's all interlinked, isn't it? That whole thing.
I think it's how long. I think for me, because I think we know it's happening, but it's just how long is it going to go on for?
I think it's more worrying now that Putin's got his back against the wall, don't you? Because how's he going to get out of this? I mean, to state TV, he can say what he wants. He can say we're winning, we're hammering him, and they wouldn't. Most of them believe him. Do you see him stopping them in the street? There's an old guy in Russia. He said, "I think what he's doing is good. He's killing the Nazis." And you think, what Nazis? So people are believing the narrative there. So as long as he shows his people that he's winning...
Well, that is the problem, though. There is a small proportion of Ukraine, a very small proportion, who are... what do they call them?
Nazis.
Well, Nazis, but they don't... Well, they call them something else. Extremists.
Oh, yeah. Well, you always get that, won't you?
Yeah. So, and he's obviously picked them out and portrayed it across the whole country, isn't it?
It's ridiculous, some of the videos, though. In fact, did you see Kim Jong-un's video of his... It's worth watching that. It's like a Top Gun movie. He comes out in a flying jacket, sunglasses, and in a slow motion, in a promotional video of their interballistic continental missiles. They launched it, and like they're all... they're really indicative, produced it, highly produced it for a North Korean thing, with the announcers, fire, 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 this takes off, and they're all going, yeah, all jumping around Kim Jong-un, yeah, and they're all walking, that film with Bruce Willis when they save the planet, is it Armageddon, when they come back and they blow that meteor up, they come back and they're all walking there in their spacesuits. It's like that scene from Armageddon. Kim Jong-un was blessed in a leather jumpsuit jacket, he's got sunglasses, and the rest of them in military. They're walking along in slow motion at the end. After I think, are they kidding? Yeah. Do they have no sense of humor? It's hilarious. Anyway,
Sorry.
So anyway, I don't mean from So the World War, but I mean.
Here's one coming in. Losing money is what I'm scared of.
How do you lose money?
Sell at the bottom.
You sell at the bottom. You get worried. You sell at the bottom.
But as a fear, that is right, isn't it?
Yes,
that's the biggest fear.
Well, let's look at that. But Steve, let's look at this. Ready? Look at this. Right. What worries you? Okay. Risk.
Yeah.
So I said this. What is risk? Essentially, the risk of capital, i.e., your money, losing your money. That's what the biggest risk is, isn't it? And investing. I say this before. Investing is gambling. Right. It's about probability. That's all it's about, and exactly the same. I need to use the same analogy because I think it's worth doing. There are certain sectors you avoid because they're odds against, and I say with traditional gambling, the odds are largely set against you. At 5, 10 to 1, you can't do anything about that. They may change a little bit, and the more money people put on a horse, they are against you. They're not even money, or they're not odds on. They're odds against. So that means your chance of winning. Now with investing, you can reduce those odds because it comes down to this, right? It comes down to, you have the chance to manipulate that, and use about assessing risks. Known risks, unknown risks. There's always going to be unknown risks, you can't do anything about those, right? The biggest risk worry is liquidation. That's your biggest risk right there. If you think about losing money, you'll only lose money by selling below where you bought at. Now, why would you sell below where you bought at? And there's a good reason why you should do that is this. If you think the company you're investing in is going to go bust, then sell. That's a real fear. There's a real fear. So, are there any companies you hold at risk of going bust? So let's remove the biggest worry, because that's the biggest worry, isn't it? Are there any companies you hold, do you believe, at the risk of going bust? Because I was looking through them,
Yep.
And I said companies usually go bust because they're loss-making, run out of working capital, can't get access to via equity debt, they've got high debt. Now, so companies loss-making and companies with high levels of debt are at higher risk. So companies own, not many of them have debt, okay? Most of them, luckily, are, like I said, listed companies, so they've got access to capital. That's one of the reasons why companies list, to get access to capital easily by equity placings and to grow using that. And that's why companies on the stock market, are more highly valued than private companies, because they got access to liquidity and capital, less risky, more likely to grow faster because they got that access to capital. So you got to look at that and think, okay, are any of my companies? So if you look through all your companies, I go through them all now, and thinking, okay, which ones are really up against it? And anyway, so they're generating cash, by the way. There's less chance of them going bust because they generate free cash flow and they're making a profit, okay? So first of all, what you should look at in any company, just to remove the biggest risk, look at whether they're profitable. If they're not, do they have enough cash to get to profitability, And then if they can't, what's the likelihood they can't raise that money? Now, if they're listed, it's a good chance again. They can just do a massive discounted fundraise and raise money. But you don't want to just keep the lights on. You want to do something with it. So the last place in a company should be doing, really. That's why I try. If I'm going to invest in a company, I want to see that the next raise they do will get them to profitability, Otherwise, if it's going to do it again and again and again, you might as well just get out because they're not generating any cash. So, they need to have at least 12 months, and hopefully within that 12 months or more of cash they're going to get the profitability. Like I said, 3 companies already, XP Factory generating cash. Trufin announced they're going to get the profitability now with 2 other companies, 2 already profitable, and Gfinity have announced it. So there's 3. So let's go through them. The other risk, of course, is just reduce deterioration of the business. Check out whether the company is growing, got value. Is the demand for the company's product service is growing? This is validation of the business. No longer a concept of idea. You can have a brilliant idea, brilliant concept, but you take it and try to make it commercial.
Yeah.
And I was listening to that, in fact, the Steve Bartlett and that other guy.
Jim Shark.
What's his name? Jim Shark guy.
Jim Shark.
Yeah, Jim Shark. But they were saying, he said, what is it? He said, ideas or hard work? He said, hard work. He said, there's plenty of ideas. Everyone has ideas. The hard bit is actually getting to fruition, getting them to goal, So anyway, growth and value. If you have growth and value, I look for basically on the valuation of the company be within 2 times sales, the enterprise value. So that's the market capitalization, minus cash, add debt. And then I want that to be within 2 times sales. So say the EV, enterprise value of something, is like 10 million. I don't want the sales to, so EV is 10. I want the sales to be within sort of 5 million or less. So I don't want to be sort of 10 times revenue or 5 times revenue. It's going to be 2 or less. So there we are. So that's have a look at that. And I've done that before, the club there. Greater risk, loss making, not growing, highly valued. And then you go from there up until less risk. But of course, there's probably less reward once you get to that less risky end. So you've got to weigh it up between risk and reward. So if you get a loss-making company that can head towards profitability, and they've got the cash there, you're probably getting good risk-reward balance there, because they are growing, they're getting to profitability, but yet they're not priced as a profitable company, So, okay, alphabetically, let's go through the stocks we own, right? Mm-hmm. And see the risk reward here. And so what am I looking for? I look for growth, value, profitability, or cash to profitability, all right? And growth provides the upside. That's it. Value protects the downside. And cash is the lifeblood and shows the health of the business. 3 things, all you need to focus on. If there's investing, what are you looking at? Growth, value, and cash. That's all you need to look at. Growth, value, cash. These 3 strings, sussed. You've got to suss. That's all you need to know. Of course, you need to learn what kind of growth and what kind of value and cash. But those 3 things, growth, value, cash, it's not easy to get those 3 things. Most companies don't have them. If you get it nailed on, you think, wow, okay. And of course, there's a bigger things you can look at. But so let's go growth and value. All that, Biome, okay. So there we are. They are enterprise value 6.5. They got just under $1 million in cash. All right. If you look down the bottom there, cash generated and used in operations for the entire year was 370k. Okay, so you can see, and they used totally in everything, investing and financial. They went by 700,000. So if we go to the next screen there, of a growth value and enough cash was there. So they didn't grow this year, right? 5.7 million didn't grow. And you think, why didn't they grow? And you think, okay, we're looking at that. So the growth isn't there. The value, they're less than 2 times sales. Yes, they're there. Cash, enough months of cash. 32 months on operations alone, 32 months or 18 months in total for net cash used. So they got more than 12 months of cash. That's fine. A lot can happen in 12 months. Hopefully the sales will go up. But if we look at it, didn't achieve that 20% top line growth. The other 2 are fine. So let's look at that growth a second. And they say, again, supply chains. Shipments were delayed up to 5 months. Our customers struggle with material and labour shortages. That's not their fault, Their products are in demand. And they say we maintain our KPI target of 40% revenue growth in the bioplastics division throughout, and that's 2020. So they'll get back to this. This is a broker forecast. So here we are, 2021. They've gone up, and they're to get 43% growth this year to 8.1 million for 2022. And up to 10 million or 11 million for 2023.
But as always with all these things, you're relying on their
That's it. And generally that's the forecasters, yeah. And of course, business don't run smooth. So even
they're not going to say, "Oh yeah, we don't think we'll actually do this." But
no. But fair play, they did an update saying previously we're going to miss our guidance because of supply chain issues. They're not telling the lies.
It's down to trust, doesn't it?
And
then
and I trust Paul. I trust Paul. He's a nice guy. He's straight out on the line. They come up with timely trading statements, and also just giving the dates of when their update's going to be, and they do it, and they tell you what's happening. So I generally tend to look at 20%. I even do my own forecast. So brokers are doing these forecasts, because I've been caught out like this before, So if somebody's achieving 20% top line growth and the valuation is good, that's all you need, but that's what they're reckoning to get. And so looking on a valuation perspective, if you go down the bottom here, even if you go on 2 times sales, right, we should see like 50% upside from here, and then they're not profitable yet. They're profitable, in 2024 probably. So they're going to cash for at least 18 months, and that's on that thing. But they may raise again before they get the profit, but I believe the valuation will be a lot higher then. I believe their revenue growth will be such that that'll push the share price up, because of course you need revenue growth at the top there to filter down. So they may need to raise, but it won't be for like another 12 months probably. But I think they'll grow a lot more then. Okay, Gfinity is one there. Market cap there. It's 16. I put 3.2, even though they've got more access to cash than that because they've got warrants as well. You could add another 2.5 million to that. So the EV would be less than that. It'd come off. 400k, this is half year, by the way. So I've doubled that. So let's go down to group value. Again, let's look at the thing. Growth, 10% only, not 20%. And they said they took a massive hit. Esports, the side of it which the business they're phasing out or trying to get rid of, was a bit slower. More people were slower to do esports events. And that was down to the pandemic. They can't help that. It's not down to them. But the good bit is, again, look at that. Less than 2 times revenue there. 48 months of cash, and 19 on total used. So they haven't got top line, they've got the values there and the cash is there. It's fine. But let's explain the business quickly. 3 parts to it. Gfinity, if you break it apart, this is the bit where it's going to be the main revenue driver. Look at that, it's going from 2021, it's only taking 30% of the revenue to 45%. And the big part that's disappointed, 55%, it will go down to 20% in 2024. So become less reliant on that. But going forward, update in the first half performance. If you look at GDM, they went up 62% to 1.6 million. All right, that is they did the same in 6 months as they did in 12 months previously. That's enormous growth in the area of the business they're focusing on. So profit of 1 million at 43%. Annualized rev per user 31% year on year, 207% increase on the rate since launch. 16 million users in February, connected with 100 million gamers each month. So in my mind, even if you look at that, right, take it apart, the figures there, figure breakdown. This is GDM excluding Stock Informer, 1.2 million 6 months. That's 200k per month. Stock Informer, 400k. That's 100 that. So that together in a monthly breakdown would be 314k per month. Just times that 12 on a run rate, you're doing 3.8 million just on the GDM side of the business. So that would be 138% growth on that side of the business. Okay. Peers are valued at 5 times sales. So if you put on 5 times sales, that's 19 million market cap. Current market cap is 16. That's only one part of the business. Yeah. So, I mean, if you look at the other parts of business, I mean, the esports business is still doing about 3 million. So we do 3 million for GDM, 3 million from esports. IP Technology, hopefully you get some revenue for that, even though it's rolling out this year. The JVs with their Abu Dhabi and all that stuff. Yeah. So maybe do 7 million this year. But put that
5 times that.
Put that on 5 times. Yeah. That's 35 million. We are at 16 million. So they don't have to do a lot. We are good value right here, and they've got cash, And so I'm not worried for a minute. So, and even if I put growth there, where I put growth, there's 20%, is it? The 30% there. Yeah, you can see the upside here, on 10 times sales multiples. Yeah. Excellent. But, okay, Getec, EV 13 million. They've got decent cash, 6.7. They've got current loans and EV there. Quickly, growth value. So, does it fit any of these? At the moment, their revenue growth is 16, so it's not quite there on the top line. It needs to be about 20. They're a little bit more expensive than I'd like. Not a lot, though. They're not like 5-10 times sales, 2.8. But they've got 69 months of cash. So plenty of cash on the current cash burn. And as yet, the I part of the business hasn't kicked in. I mean, these hydrogen hubs, they've already signed 3 hydrogen hubs. The broker suggests EBITDA of 1.7 per hub. That's 5.3 over 3. Now, that on a times, 10 multiple, That's a 300% upside from here on current EV, so...
And the way they're funding that means that
low CapEx.
Exactly, they're not going to be spending, so yeah.
So I'm happy with that. I mean, this is their year and the year after. They're not really kicked in these high growth areas, hasn't really started generating revenue yet. SpaceandPeople is one I've recently brought up. Silly market cap here, really. 2.4 million, cash of 1.3, but some of that is the big worry here is loans. But I believe they are growing and they'll grow out of that. So they only used 300k in ops, 600k altogether. So let's look at this. Of course, they were locked down, so it's going to be a big growth here, but most of the year they weren't open for. But nevertheless, still 61% year-on-year growth from 2.8 to 4.5 million. They got 54 months of cash at their current cash burn. So they got all that. All three there tick the box. But look at this, right? That's 61% growth, but these like-for-likes are not real because 2020 was an awful year. 2021 was a bit better because of COVID. But if you go back, if you break this down, H1 was half shut. Opened back up in April, I think, at the end of April. And then H2, 3.4. So you just break the down. H2 was 3.4. That's monthly of 566,000 monthly. Okay, so if you put that, and that was with a really bad December because we were back in the lockdown in December. Now December is a very busy month for them. They do sort of outside spaces, in retail areas. Very busy month for them. Shut down. They're saying work from home. So even with that, 560k. So look at that. Omicron wipes out retail recovery as December football drops. At the Retail Gazette, which I know you subscribe to.
Big fan.
But even if they replicate this in 2022, right? Even with a soggy December, that's times 12 months, 6.8 million. Now that's a revenue of 51% up. That's growth of that. But look at this. Interim results. Portfolio of venues is significantly larger than pre-pandemic and resulting opportunities as business recovers are positive. So they've got a bigger portfolio. So let's say they do 20% growth on that. That's 680. That's that monthly revenue. Oh, next one, 8.1 million. So even on one-time sales, that's 220% upside. And yet they've removed 1 million of annual costs, and they were profitable pre-pandemic in 2019. So I think they could be profitable this year, and they're not even valued at half sales, not even 1 times or 2 times. So when you put on 2 times sales, that's 9 million. That's 270% upside. So that's why I like them. Trufin, quickly. Trufin, oddly, is the most scalable company I think. No, Trufin is the most scalable company I think I own. All right.
Yeah.
But it doesn't fit any metric. And sometimes that happens, because they've spent a lot of money.
What do you mean it doesn't fit any metric?
Well, I'll show you now.
Right, here we go.
So they're 73 million market cap, okay? The EV is 67 because they've got a bit of debt there and they've got cash of 70 million as well. Growth and value. So they spend a lot of money and revenue. Let's look at these 3 figures. So 11% drop in the growth because they spent a lot of money on Satago. They've changed the business. They were loaning on their own book. Now they're a software as a service business. They have no loans themselves. Lloyds will do the loan book side of it, and they'll be a software as a service. But that has made sure the revenue came down as a target, but now they can really power up on it. Because of that, they are 5.2 times sales, but they've got 26 months of cash. So it's plenty of cash there. It's fine to get profitability, but the growth isn't there, and the value isn't there. But I think there's huge upside here. And in fact, if you look at the broker forecasts...
Yeah, everyone take that in quickly.
Yeah. So, no, I'll go through this, right?
It's worth saying that after this live stream finishes, this video will be available, so you can
you can
pause some of this and look at some of this data.
So look at the top line here at the top, right? 2020, 2021, right? So that went down. But then they're going to go up to, and you can see the revenue growth is on this line here. So 52%, 78%, and I've dropped it to 20% here. It's going to be bigger than that. They're going to plug into bigger companies. So 20%, I put it in 20%. So even on that, right, on a 5 times sales, and that's quite conservative for a software as a service business where it was best in class, that's got Lloyds Bank as a main client. We're talking about, and I'm seeing it really. I don't see. It's software. Once it's done, I mean, it's hugely scalable with clients around the world. Yep. It's one of those things, business you'd love to create. And one of the members' brothers did create it, and he knew it was head and shoulders. He said, "I knew it was head and shoulders above any other competitor." It can scale massively, and literally they plough a lot of money into it.
Yes.
Developing it, a lot of money's gone into it, and now is the year it starts taking off.
Yeah, and the thing with all SaaS businesses, they are. It is always a challenge to achieve that scale, but when you've got someone like we said, Lloyd's, that is a huge endorsement. I mean, that's going to help because that's obviously a real feather in their cap.
And the last one, this is XP Factory, of course. That's why it's alphabetical. It's not Escape anymore, so that's why it's last. We've got 45 million market cap, cash around 10 million. In fact, a bit more than that, but they probably have to pay some more out for the remaining the earn out thing. If they achieve the goals, Boom Battle Bar, they pay them in 2 tranches. But EV of 35, these are $1 million in operations. Growth and value. So again, the like for likes are a bit odd here, but 159% growth there. All right. The value is not there, but we'll see it will be next year because the revenue goes up massively and then it drops to about 1.1. But they've got 120 months of cash. The most important thing of all is growth. We're investing in growth companies. Are they growing? If they are, that's the thing. And they got lots of cash. The value, okay, you may say, they're a bit overvalued. But if you look at this, I'll show you on the thing. So if you look at those blue bars, the value, it goes down to from 5 times revenue to 1.4 next year because the revenue goes up from 6.4 million to 25 million this year. So you can see that, and then I just put in sort of growth of 20%. I think it's still going to be bigger than that. But again, we should be on 68% higher than where we are now, the share price, and then doubling and then almost trebling there on sales. And that's 3 times sales, 10 times EBITDA. Again, this will get more efficient the more they have, the more they're just starting. I think Boom Battle Bar will go down so well in America, And once you got the concept right, you can have like a 100 franchises in America. Same with Escape. I think they will be doing that, but they're just focused on this country at the moment. But and not only that, they're generating cash now. That's the difference at the moment of those companies. This is the only one that's generating EBITDA positive cash flow. So that's why it's less risky than others. Yeah, but it's going to grow. So I'm
going to ask a question that Tom's put in. Which one of the companies you hold represents best value now for a new investment?
Well, again, I've on 5 of them. They're all quite risky because they're small microcaps. They're all high risk. Like I said, XP Factory is probably the safest. Because it's generating cash, but it's got a pipeline there. It's laid out. That's why I kept saying I did a video a long time ago, a roadmap to £1. It's there. It's mapped out. They've got legal agreements to roll these sites out. They've got the cash. There's very little risk. I mean, what can stop them doing that? They're based in this country. They're not based in some far-flung country. They're doing it. So they've got the cash. They've very good deals with the landlords on all of the things. So to me, that's all they have to keep doing is opening these sites, and they're doing it. So to me, I mean, as far as size and scalability, I think Satago could be, what they say could be like 500 million, almost $1 billion market cap. If it continues doing what it's doing, it could be very impressive. But
it's a good question from the Colonel. The companies he's invested in are pre-profit. They're now overvalued. Price has collapsed quite a lot. I'm still in a significant profit. Is it always wise to hold till a dividend? Going back to what you were showing earlier, with your analogy.
Well, it depends what you want. I mean, how much profit do you want to take from a company? Because the reason why I invest in a company is, again, what's your time horizon? Do you need the money now? If you think there's lots more potential in these companies, why not hold? Because if you like sitting on 10%, 20% profit, is that what you want? Because I don't. The reason why, if I wanted that, I'd go into big caps, I'd get a dividend. And so I'd earn 5, 10, 20% a year. I mean, last year hasn't been good for microcaps. It's gone down, of course. But microcaps, they've got a high beta. They're very volatile. So that means they sell off fast in the market, more than the market, and then they go further than the market. So the market will be there. They'll go right up there and they go down as well. So if you want that return, but I mean, it's up to what you want. I mean, if you want multiple returns on your money, you've got to hang on to them, haven't you? I mean, if you want 10%, sell when you get 10%.
But all the way through to a dividend, that's... by then, value.
Okay. Look at yourself as a business owner, right? If you are a business owner, right, literally, if you maybe a CEO, like I say, a shadow CEO, if you were sitting there and you've got your share price is in profit, you're in profit in the shares, and it starts going down, but you're happy with the way business is going, but the share price starts going down, would you just sell your shares or sell the company? Because we're talking about a business. Would you sell the business? So that's how you should frame it always. You're not going to sell the business, because the share price is going down. If you think the future potential is a lot bigger than what you have at the moment, why would you do that? Because you will jump out, so I'll jump back in. But generally, you won't. You may miss a move. You look elsewhere, and then you think, I've done it many times. I've done it in companies, looked elsewhere, the grass was greener, and then all of a sudden, a company's gone through the roof. And if it goes through the roof, then take profit. If you go a couple of 100% within a year, or it goes nuts, take some money off,
Yeah, that's the thing. You don't have to sell out completely. Take some money off, and then even hold on to a dividend. You might hold a smaller holding, but for longer term.
Well, there's a way of doing it as well. If you're buying companies, for example, at a good value, like 2 times sales or 1 time sales. Let's say you buy companies 1 time sales or cash, get a profitability. Once it hits above peer average, say 3 or 4 times sales, and say it's a sedentary company, sell some. You think this is overvalued now?
We did that with Bidstack, didn't we?
Yeah, so you sell it, it's overvalued, it's 3 times, 4 times sales now, or I'll sell some of it, I'll take my profit out. Then, again, you can have cash there. You may even want to go back into it if it drops off a cliff again. They go, this is good value again now. And the market's just sold off, the business has improved, I'm going to go back into it. And so you can do it on a valuation level rather than just a price level,
Okay. Dave says, that's a good point. Odds against can be fine. You need to consider the chance of success, not just the profit versus loss. Better a 5-to-1 shot with a 30% chance of success than a 1 in 3 odds against shot with a 60% chance of success. I think anyone's saying no. Yes, so you're assessing the relative.
I know.
Success.
Yeah, absolutely. But what I'm saying is, if you've got, for example, if you're a company like oil and gas, I've said this lots of times, oil and gas companies are drilling for oil, right? They are massively odds against, and I see people going big time out on Twitter and going into them. Why would you do that? If you had held 10 of those stocks and they're all doing wildcat drills, one of them would have to succeed. That's the chances.
Yeah.
So why would you do that? Why not just go for a business? You're hoping to get, a gusher, a success of that, and hoping to go 5 times in 1 or 2 days. But why go for that? Why not just say, I'm going to go for a company that's actually generating now positive cash? That, to me, reduces the risk massively because it's not just an idea, it's a business that people are validating by buying and not only that, the demand for the service or the product is increasing every year. That validates it, okay, and going forward. So, I mean, that kind of thing in my mind, cash to get a profitability, all that, you're odds on against success rather than odds against, So, anyway, we're 5 past 11.
Yeah.
And my wife is hanging around. Hello, wifey. You shouldn't be topless sunbathing in the garden.
It's been appropriate when me and Peter here,
Yeah. When, Lolly. Right. That's it. I think one more slide. Final thought, focus on the business, not the share price. And that's all, folks. Thank you very much. You can catch us on Catchup, of course. And now we're going for a nice walk. And in between that walk, quite a few pubs. Lolly, come here.
Supporting the economy.
Come here. That's all, folks.
Say bye, Paddy.
Bye, Paddy.
The Share Pickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.